Greetings on behalf of your financial team at Paul R. Ried Financial Group. Well, so far this year, we've experienced inflation above 8%. We've experienced rising interest rates, significant market volatility, which has resulted in investment declines. I'd like us to spend about 12 minutes together so I can share the 5 things we want you to keep in mind during this time in the economy. Let's begin. Number 1, bear markets and recessions are not unusual. You see, a bear market is traditionally described as a 20% decline from an index high to the current level. A recession is typically defined as 2 successive negative quarters of gross domestic product growth. Now, we've experienced 1 quarter of negative growth in first quarter of 2022. We'll see how the second quarter lines out. But I want to suggest to you that when we hear those terms, our emotions may kick in. We may think wrongly, by the way, that number 1, our money won't last. Number 2, we're in the wrong investments. Number 3, the economy won't recover. And number 4, we might think we've got to do something and do it now. Well, again, those are wrong observations. Let's examine the reality of bear markets and recessions, because remember, they're normal. Well, since 1928, history tells us we've had 26 bear markets, and we've had 27 recoveries, so 27 bull markets. Every bear market has been followed, of course, by a bull market in time. We just don't know exactly when that's going to occur. Further, if we look at rolling 10-year periods in the U.S. stock market, history shows us that roughly every 7 to 8 years we see rising markets, and every 2 to 3 years we see declines. So declining markets are normal. The overwhelming odds, however, is that we'll see a rise during that market cycle. So we know the market's going to be negative, we just don't know when. And we're going through a period of that time right now. Well, let's look at number 2. Number 2, we want you to refrain from opening your statements or checking your balances during this time. Remember, your account value, when you look at the statements or check your balances online, is the value if you were to liquidate the entire account as of that day or the preceding day. And, if we have a short-term time horizon, then that's relevant. But remember, that current value is only relevant if we have that short-term time horizon and we liquidate the account. You see, what's most relevant for a long-term investor is that we have gone through a thorough planning process, which we have, resulting in a portfolio of foundation and growth that's consistent with your objectives of your return objective, your risk temperament, your income needs, and your time horizon, reflecting our research and reflecting a tilt towards the season of the economy. You see, we want to let your portfolio work for you and for us to work for you as well. And of course, we make changes and adjustments as appropriate. Well, let's look at number 3. Number 3 I want you to keep in mind is don't let the media influence your financial decisions, social or print media. You see, the media certainly reports on the news of the day, and oftentimes it's negative, and oftentimes it's sensationalized. So the motivation of the media is not necessarily to report the news based on your best interests. Because remember, it's really to get viewership and advertisers. Advertisers, of course, pay the media. And I would go one step further and say oftentimes the media is conflicting in what it says. Let me give you an example. The Wall Street Journal this weekend. Let me read in page A1, front page, headline of the Wall Street Journal. It says this: markets rally to snap losing streak. Then it says broad gains lift the Dow and the S&P 500 to close their best weeks since November of 2020. Now that makes you feel really good. But then I turned to the second section, B1. And let me tell you the headline, big print on B1, same issue. It just says this: what's in store for stormy times? So all of a sudden my emotions were pretty high when I read the front page and then not so good when I read the second page. So I'm going to encourage you, be careful of the media. Don't let it influence your decisions or your emotions. Well, let's look at number 4 we'd like you to keep in mind. You might think of the patterns, but then you might think this. You might think, Yeah, Paul, but this time is different. So number 4 is this time is different, yes and no. Let's explore that. Every market event, including this one, including the global pandemic, is different. But in many ways, the market patterns are quite similar. Let's go in a bit deeper in that. Of course, we know 1987, that was Black Monday, the biggest point drop in history at the time, percentage-wise, and we recovered from that. We know also, going back in history again, the year 2000, that was called Y2K. We also had the tech bubble back then. It was thought then that market patterns would change and we may not recover. Well, we did. And then, of course, we had 2001, 9/11. First time we were attacked on our soil. Again, a monumental time, and different markets went down, but then they recovered. Of course, many of you remember 2008 and 2009, called the Great Recession. We saw foreclosures and bankruptcies at alarming rates. We saw the real estate market not do well at all. Naturally, we recovered during that time as well. And then, of course, we all remember March of 2020, the global pandemic. We know what happened then. You see, the patterns are this. The patterns are the markets tend to overshoot on the upside. A certain event triggers a market decline. The market then self-corrects, reaches fair value, then overshoots on the downside, then goes back up again. And that's the pattern that we've seen over time. That's the pattern that we're seeing right now. You see, what we do know, it's nearly impossible to know how long the declines will last and when the actual patterns will begin. I would defer to this statement, however. It was once said that it's not timing the market that's most important, it's time in the market that matters. You see, going a little bit further then, history shows us that missing a few of the best days in any market may very well have us miss a high percentage of the gain over the total market. Let me illustrate. If we go back to the time period of December 31st, 2006 to December 31st, 2021, 15 years. If you would have invested fully during that time in the S&P 500, the US stock market index, your return would have been 10.66% per year. Now, if you missed just the 10 best days, maybe trying to time the market, maybe been out of the market, whatever it might be, your return would have been cut in half to 5.05% per year. Now, if you missed the 20 best days, your return would have gone down to 1.59% per year. And you missed the 30 best days, you would have had a negative return for the entire market on an annualized basis. And what history also shows us is oftentimes the best performing days shortly follow the worst performing days. You know, we made it successfully through each of those times. We'll make it successfully through this time as well. Well, let's look at number 5 we want you to keep in mind. And then number 5 is about our process for you. You see, number 5 is that we employ a proactive approach on your behalf. You're invested in actively managed funds where managers have discretion, and at this time they're looking for excellent values at this time. In fact, they're looking at great companies at lower values to potentially accelerate more quickly as markets turn. Their goal is not necessarily to grow the balance over 3 to 6 months, but it's more 3 to 6 years and beyond. It's long term. The second part of that proactive approach is that we're monitoring those managers very carefully. We're looking out for those managers and for you on your behalf, making changes as appropriate. You see, the reality of your portfolio as well is that it reflects our research and our experience that we've gained over the last 3 decades going through those markets. With the components that you see in your portfolio now have been customized based on our experience and naturally based on your objectives. So let me summarize the 5 areas we want you to keep in mind. Number 1, bear markets and recessions are normal. Don't be surprised for those terms. Number 2, refrain from checking your balances. Really, for the long term, it's not really relevant. Number 3, don't let the media influence you because, of course, we can get our emotions involved and that can inadvertently misdirect our investments. Number 4, this time is different. Yes and no. And number 5, we're proactive on your behalf. Well, our commitment to all of you is to stay proactive on your behalf in our support, in our service, in our management of your portfolio. keeping you informed. Now, we may be in this cycle for a time. We're going to stay abreast of it and keep you informed. Remember, above all else, that we're committed to your success. And what we want you to do, if there's any questions, comments, if you want to reaffirm your goals, whatever they might be, please don't hesitate to reach out to us by phone, by email, certainly at our next meeting as well. Well, finally, as we wrap up, I'd like to share 3 quotes from 3 very noteworthy money managers about the market and about the economy, about their perspective. They are Warren Buffett, Peter Lynch, and John Templeton. Let me share what they say about the markets and the economy. This is what Warren Buffett says. Warren Buffett says, "We don't have, never have had, and never will have an opinion about where the stock market, interest rates, or business activities will be a year from now." You see, Warren Buffett says, I don't know about the markets, but I do know about companies and how to put a portfolio together and what to sell and what to buy. Then we have Peter Lynch, a well-known growth manager in the 80s. And he says this, "I have no feeling for the direction of the market over the near term or the next 3 to 12 months, and that has always been my position." And then finally, I think John Templeton sums it up very nicely. He simply says, "Ignore fluctuations. Do not try to outguess the stock market. Buy a quality portfolio and invest for the long term." Well, these quotes weren't said last year. They were actually said over 2 decades ago. And just as they applied then, they apply today as well. Well, folks, it's been my pleasure in spending this time with you. Thank you very much for your attendance. I would say this, if you have family, friends that have concerns about the market that would benefit from this perspective from what we're sharing today, feel free to forward this on and pass this on to them. I want to, first of all, again, thank you on behalf of your financial team, on behalf of Tim Kimmel, Adam Jordan, and myself. Thank you so much for your confidence, your support, your trust. We wish you a good day, and God bless. Take care.